Real estate's a freight train. It takes a long time to stop. It takes a long time to get back going. And we see it kind of bottom out flatline for a while. So, hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer. And today I'm going to talk a bit about markets and kind of what's going on in the markets. Obviously, a lot is happening, and I've talked about that, but I'm going to specifically just talk about multifamily, a little bit about other commercial real estate. So I'll give a quick breakdown of overall just commercial real estate, and then I'll dive into the multifamily. First of all, I think it's interesting to see that overall smaller markets, tertiary markets are doing really well, where bigger markets aren't. And one of the probably the main drivers with that is supply. And so specifically when we talk about multifamily, but when we talk about really supply of office, industrial, retail, where the supply happens is the big cities. And we saw a large amount of supply in those markets, and they're struggling in the larger markets where the smaller tertiary markets haven't seen that influx, and so they're still doing really well. So, because overall, really, the economy is doing pretty good. Although right now we just saw GDP numbers come out and not looking so good. We're not going to dive into that. Maybe we'll do that next week. Um, quickly, office is still obviously doing poorly. Um, they kind of just continue to remain the weak spot, especially, unless you're like really well located. But most of the downtowns aren't doing well. B and C class are just not doing well. Prices continue to fall. So prices fell 2.5% again, quarter over quarter, and 9.2% annually. This is nationwide. But you are seeing back to work and possibly stabilization in some bigger markets. So we'll see. I'm actually fairly optimistic that office is going to bounce back pretty well. But I think it's going to be select as well. It's got to be well located properties. It's got to be newer, have some amenities, all that kind of stuff. So you want to be selective if you're an office investor or thinking about getting an office. You want to be really cautious. I wouldn't just go out and buy anything. But be really thoughtful, really cautious. And I think there's going to be a lot of money made in office over the next, couple decades here. Industrial and retail, those have both been really steady. So industrial, prices have dipped a little bit, but in this over this last quarter, so 1% down, quarter four 2024 nationwide, but overall prices are still up year over year, 2.5%. So growth hasn't really been great, but look, it's better than zero, right? It's better than negative, which you're seeing in office. So retail, same thing, pretty strong. Retail's maybe the strongest asset class that we've been seeing. So retail prices are up 1.1% quarter over quarter, which, we've been really seeing that 1 to 1.5% quarter over quarter growth, which, obviously translates into 4 to 5% year over year growth for retail. We've been seeing that for quite a while a lot of other asset classes are struggling. Retail has remained strong. And the only weak spot in retail has really been large regional malls. And so if we're talking like just strip centers, shopping centers, those are doing well. If you're talking big regional malls, those have definitely been struggling. Multifamily, we'll dive into multifamily, but multifamily prices are actually ticking up, starting to tick up. So 1.1% quarter over quarter. You know, performance, in year over year is still down 2.1%. So Still not extremely strong, but quarter over quarter, we're seeing growth. And if you're a multifamily owner that's looking to sell, that's a good thing. If you're a multifamily buyer hoping for uh, steal of deals, maybe that's not so much of a good thing because we haven't really seen any steals out there, and we're starting to see potentially the change of the guard here. So let's dive into multifamily. I'm going to dive into multifamily overall, and then we'll dive into some markets. So first quarter of 2025, national apartment market absorption outpaced deliveries. And this is the first time since 2021. So we had 102,000 units leased, and we had only 95,000 units completed. So that's in quarter one of 2025. Now we are starting to see a slowdown in units being completed, but we're still pretty heavy amount of units being completed. So 95,000 definitely down from 2023 and 2024, but we are still seeing a lot of units being completed, but we are seeing even more being absorbed. So uh and that's continued to it's expected to continue. So there's really more demand right now than there is supply. There's only 265,000. Now, this is according to Cushman Wakefield. I've seen numbers higher than this. But Cushman Wakefield says 265,000 new units slated for delivery in 2025, which is about half of 2024's total. Now, I have seen from other reports closer to that 375,000, but that's still a significant drop from 2024 and 2023. So um, we had we were on pace. If we continued 2023, 2024, we would be starting to get in a really bad position. Now, some of the southern markets are not doing great. They've had a good amount of rent declines, and we'll cover a few of those today. But most of the rest of the country, the north, east, and the Midwest, and so on, have actually not had that much delivery, and so they haven't really seen much of a slowdown in their rents. In fact, some of them are doing really good rent growth. Uh, Construction starts are hitting an all-time or not an all-time low, are hitting a low or going to be hitting a low in 2025. So, in low meaning pre-pandemic. So lowest level since 2018. Pipeline is shrunk, so it's down to 545,000 units, which is the lowest the pipeline's been since 2018. Now, the 545, some are getting delivered in 2025, some are getting delivered in 2026, and some won't get delivered until 2027. So some of these, especially in towns that have stricter regulations, it takes several years for those to be delivered, and some won't even get delivered at all. So um, the South is absorbing units very quickly, which is a good thing because that's what's the Southeast has been really hurting as far as how many units have been hitting the market. But population growth is strong there, so they're really seeing good absorption. And nationally, average rents rose $1,894 per unit, or rose to 1,894 per unit, which is actually up, which is a good thing. Well, it depends on who you are, but it's a good thing if you're an owner. It's only up from 1866, but it's up from 1823 a year earlier. So we're actually seeing, some rent growth, which we haven't really seen much of, and it's pretty slow, but it is rent growth. And so I think that most people see that as a positive. Most people see that continuing as deliveries continue to drop while demand remains high. So I'm going to hit on a couple markets. First of all, I'll hit on the markets that we're in, which Twin Cities. Um, Q1 economy is pretty stable, adding 19,300 jobs. Um, Construction slowed significantly. Um, just over 20,000 units were delivered since 2023, and there's very limited starts. Demand has improved, and demand's always remained strong, but there was 2,092 units absorbed, which is 120% more, 127% more than what was delivered, which is 922 units. So last year, there was a little bit of a trend in oversupply. There was less units absorbed than there was delivered. And now we're the opposite, actually, significantly opposite. So um, vacancy levels, although never got really high in the Twin Cities, are stabilizing, especially in the suburban areas. So rents continue to rise, so reaching an average of 1,542 per unit, um, and concessions are also declining. So Louisville, Kentucky, um, good growth in Louisville, below average vacancy rate. Things are happening pretty well there. Vacancy rates under 6%. There's very little construction. Um, I don't have that number in front of me, but rents is expanding by about 4% in Louisville and forecasted to reach a high of 1320 per month in 2025. Columbus is another market we're in. We really like. There's a lot of good things happening in Columbus, Ohio. So you've seen uh, big companies really putting a footprint in Columbus. You've seen Honda, Intel, uh, Meta, um, putting a lot of money into Columbus, and that has created excitement for the Columbus market. There's a total employment expanding by 10,000 jobs. Um, Inventory growth, though, is 3.6%, which is the fastest in the major Midwest markets. So we are seeing some vacancies happening in Columbus. So the vacancy is expected to rise to 6%, which is higher than it is right now. But even despite that, rent growth is still 3.4% year over year, which is really strong. So it's a little bit higher than kind of its average rent growth, which is 2.8%. So um, I could see that slowing down with the amount of new deliveries that'll happen, but there's a lot of demand and there's growth in the market. So Columbus is absorbing really, really well. All right. So I also looked at just a few other markets. So if you're not in those markets, I'm going to hit on just a couple so you can understand kind of what's going on across the country. I picked markets in just different geographical areas, some of the bigger ones. So I picked Charlotte, North Carolina. Charlotte is seeing a significant influx of units, 1,200 for the third consecutive year, record slated of 12,000 units. 17,000 units are slated for 2025. And that's going to really definitely hurt the market. And so expect rent growth there to actually be negative in 2025. One of the only markets that will probably be, I should say one of the only, there's a handful of markets that are projected to be negative in 2025, Charlotte being one of them. I'll cover another one in just a minute here in Austin. But we're seeing a lot of new deliveries, although absorption is really strong. It's not quite enough to absorb all the units that are going to be delivered. And so, expect another year of struggle there in that market and rents to decline by it, forecasts. This forecast from Cushman & Wakefield's is negative 1.3%. I've seen anywhere from a growth of about 1% to a decline of negative 4%. So somewhere in there, but stagnant, if not declining rents and higher vacancy rates. Dallas, Texas, Dallas has really bounced back. It's doing really well. It continues to lead multifamily performance. So it's got a ton of job growth, a lot of huge diverse economy. So rents are forecasted to rise for the first time in several years and rise by about 2.9% year over year to 1,589 per month. And occupancy is also expected to increase to 93.4%. So Dallas was getting its butt kicked a little bit, not terrible, not as bad as some of the other markets, but now it's really strengthened its position and is continuing to see some stability and growth. So expect Dallas overall to see some good things happening. Of course, huge markets that I'm talking about. So every market you've got to really dive into what's going on. We talked about the strength of Minneapolis, and we know uh, full well that the city of St. Paul is not seeing the same thing that the suburb. We just bought a property in Champlin, Minnesota. Um, City of St. Paul is actually seeing rent decline, where Champlin is seeing 4.5% rent growth. So big differences. As you get into the little nuances of the market, definitely be aware of that. All right, Austin, man, another year of record-setting multifamily going to hit the market with almost 37,000 units. Um, However, net absorption is really strong as well, and the forecast of 34,000 units in Austin. So, will there be continued influx of supply that's going to negatively affect the market? Yes, but not nearly as much as what you'd think with all the units being built. So, occupancy has dropped to 92.3%, and rents continue to decline. Um, you know, Probably going to continue to decline in 2025. I've seen forecasts. I don't know why there's not a forecast here, but I've seen forecasts anywhere between kind of that Charlotte number where you're seeing like negative 1 to negative 5%. So, and vacancies are expected to continue to climb a little bit, but there is an end in sight. So when you look forward to 2026 and 2027, there'll be definitely less deliveries and likely really strong absorption still. So rents will decline in Austin, but expect that to change the story in 2026. Atlanta, Georgia, another strong market, or has been a strong market, really hot market. And that one saw some negative rents. It saw some overbuilding that happened, but in 2025, rents are expected to grow by 2%. So really good. Occupancy is rising slightly at 92.4%. One of the things that you got to be careful with Atlanta is that a lot of the residents don't pay their rent. So it's got a huge economic vacancy rate. A huge amount of the residents end up getting evicted every single month and are not paying their rents. So definitely something to watch out for in that market. If you like it, that's fine. But you just understand that that comes with the territory there. Looked at Salt Lake City. A little bit of decrease in occupancy, 93.8%, and expecting rent increases of around 2.5%. So, um, you know, really good rental absorption happening in 2025, expecting that the vacancy will basically flatline and coming in about 94% occupancy by the end of 2025. Last one I looked at was Tampa, Florida. Tampa Bay is actually doing really well, even when you consider the amount of units coming online. In 2024, it absorbed all of the units, actually just slightly more. It absorbed 12,960 units, where it delivered about 12,500 units. They are expecting to see a lot of units again in 2025, about the same as 2024. But again, absorption is really strong. Rent growth is expected to be this year. Last year was 2.2% decline. This year is expected to be a 1.8% rent increase. So summarize it. We've got different markets across the country. Overall, what are things happening? As I mentioned earlier, we've got construction that is slowing down in most markets, and even the markets that I mentioned, the two is Austin and Charlotte, that are having an exorbitant amount of construction that's going to outpace the demand. They'll be weak in 2025, but if you look at the forecast in 2026, there's going to be a lot less units coming to the market. And so that'll get eaten up because those are good growth markets. They're good long-term stories. And maybe we're going to continue to have struggles for another 12 to 24 months, probably closer to that 24 months, but they are markets that will rebound and will be very strong eventually here. So maybe good markets to look at to see if you can find some deals here in 2025, or early part of 2026 or through 2026. Real estate moves slow. I reminded somebody of that today. Like, look, real estate moves slow. This is a freight train that survived till 2025 that everybody put out there in 2023. It's like, no, that made no sense ever. If you're only going to survive till 2025, that means you're going to fail in 2026, or in 2025. So, uh, real estate's a freight train. It takes a long time to stop. It takes a long time to get back going. And we see it kind of bottom out flatline for a while. So if those markets that are seeing a high amount of inventory come in and maybe have some pain still, those are going to be good markets to look at investing in over the next really 2 to 3, 4 years. Even you'll probably find some opportunities there. Now, I can't guarantee anything, of course, um, but overall, markets are most multifamilies actually holding up pretty well. Um, Prices have declined nationwide by almost 25%. And of course, local markets are definitely varying from there. But what we are seeing is that even though they've declined by that amount, the prices are starting to go back up. People are comfortable now with where rates have been at. They've been there for quite a while. So people are underwriting to these rates. Sellers are still stubborn. They don't want to sell their properties for that much more. Transactions are happening. Transaction volume is way up. 2025 is looking like it's could turn out to be a really strong year, best year since it started to slow down in 2022. So we'll see what happens there. For us at Endurus, look, I mean, it's prices going up. It's not a good thing if, as for a buyer. We have a couple properties we would love to sell. As a seller, definitely a good thing. But as a buyer, we are having a tough time penciling properties. And I know most of the people I talk to are the same. They're having a really tough time penciling properties. So just stay diligent out there and continue to look at every deal. And, it's like we talk about, man, we really want to get a deal, but you can't stretch on these deals. And when you do stretch, that's when you get in trouble. And I know there's people that are doing it. And I think there's going to be people that, didn't learn their lesson because things didn't fall hard enough, unfortunately, and fortunately. But things didn't really fall far enough over the last couple of years. So people are going to, have to learn their lesson again, or they never did learn their lesson. They're going to, find out the hard way eventually. Where do I see rents going in the future nationwide? I think we're going to see fairly slow rent growth over the next several years, while interest rates continue to stay likely heightened over the next couple of years. And but demand will be really strong. So you're going to see vacancy rates, just continue to tighten here. And but I don't think you're going to be able to really push rents too much on tenants. I think you certainly will see some rent growth, but I don't expect it. Some people I've talked to think you're going to see 5%, 8% type rent growth again. And that could be possible. I just don't see that happening over the next several years. I hope I'm wrong. Well, I actually kind of don't hope I'm wrong, because when you do see rent growth like that, it becomes unaffordable for residents. So what I would love to see versus the rent growth is I'd love to see expense growth stagnate. Now that doesn't seem possible either, with, you know, potential tariffs and all that kind of stuff. So we'll see what happens. Speaking of the tariffs, I had a text conversation with somebody today, and we were texting back and forth on the tariffs, and he said, "Well, I think the tariffs are going to, raise construction prices by about 25%." And I get the concern, but my thought on that is, well, first of all, materials are only a portion of your expense when we're talking about construction or really anything. We've got labor as well. And so labor is likely not going to go up that much. Now, of course, labor does go up, but not that much. And so even if the tariffs make materials 25% more expensive, the labor is likely not getting much more expensive. So you have to take that into consideration when you're looking at the construction price and how much that's going up. So really that brings the construction price down to, closer to that 10 to 12% increase in construction price. And one of my theory, which is not just mine, this is an original to me, but my theory that I subscribe to is that with tariffs, if they do take hold and continue for the long term, what you will see is it's going to be kind of an absorption across the board. So the manufacturer is going to absorb some of the tariff hit. The distributor is going to absorb some of that. The wholesaler, the end supplier, and the consumer. So you're going to see everybody absorb some of that. So everybody's margin is going to get a little bit tighter. In that, so a 25% tariff doesn't mean the price goes up 25%. Maybe the price only goes up, 8, 10%. Well, which is still significant, right? But the other thing to think about when you think about tariffs, it's not necessarily a long-term inflationary thing. When you look at a tariff, you're looking at it's a one-time hit. Now, I'm not saying that's any better, but it's the price goes up to maybe slowly, but it goes up for a certain period of time, and then it hits that kind of point, and then it goes up normal inflationary, 2% or whatever it is. Again, not saying it's a good thing. If prices go up, it sucks. I don't want to spend more for anything. But I don't see these tariffs being as damaging as what some people think. And again, I could be completely wrong. I'm not an economist. I'm just a dude that sometimes thinks he's smart and other times is not so sure. So, anyways, so that's all I got for today. Hope this was good update on kind of multifamily commercial real estate, I guess, economy a little bit. I'm Todd Dykstra, signing out. Make every day a Saturday.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.